I've got this farm with the same program yield as the Olympic average county yield. In most cases, you're either going to be higher or lower than this number. But if you happen to be exactly the same, and the county raises an average yield of 170, then at $3.17 is the break-even point. At $3.17, if your yield is exactly, your payment yield is exactly the same as the Olympic average county yield, 170 in this case, and price has to drop below $3.17 if the county raises an average crop before your payment under PLC is bigger than what it is under Park County. It's not enough for it to be below $3.70. Not enough to be below $3.70. It has to be low enough to where the payment's going to be bigger than what you're going to get from the Park County. So if the price drops to $274, so you're getting $163 from PLC. You're still getting paid over here under the other program, but it's at that 10% top loss, 89 bucks. Remember what I said earlier? If that was 25%, you could all go home. Why? Because this number here wouldn't be stopped at $89, would it? It'd be substantially larger than it, 2.5 times that size. Yeah, that would make this really easy. I could tell you what to do. As it is, I can't. So here's what you're left with. Do you think if you are in a financial situation that at $3 corn, you're bankrupt and you have to call the auctioneer, you're done at $3 corn. If that's you, even though you think maybe Ark County is more likely to pay you more money, you might still go PLC because you can't afford to take the risk of 280 corn. If you can't afford the risk of 280 corn, you might still take PLC. It's catastrophic risk protection. This is the exact argument that's been made to me in Washington by folks that really want people in PLC. They are arguing that you need to worry about the catastrophic risk aversion that they teach you in graduate school is the reason you would take PLC. Even if you think the other program's going to pay more, you take it because you cannot afford the catastrophe loss of a 280 corn price. Remember, that has to be the average for the whole year. That's not the market low at harvest time. Okay? Now, the problem with that is, maybe not you so much, but people I deal with, you're really not risk averse. You really, some of those guys in D.C. need to come to Dodge City, Kansas, and drink beer with Dodge City cattle feeders. Let me tell you how they feel. Oh, lost a couple $100 on that last pen cattle. No real problem. We'll just feed 3 pens this time, probably make it all back and then some. All I need is a banker with some guts that'll hang in there and keep financing me because it'll roll over and eventually it will pay off. I swear to God, if those folks weren't feeding cattle, they would be down here in this casino playing there. I mean, they are not really risk averse. They might even be risk seeking. As a general statement, most farmers are not quite that extreme, but you aren't terribly risk averse. And so I'm probably not scaring many of you with a $2.80 price, particularly where corn's at right now. You're probably thinking, well, it's probably going to get there anyway. Now, I don't know whether it will or it won't. Nobody else does either. You got 5 years. Lots of things can happen in 5 years. We could go to a hot war in Europe. Could happen. Oil keeps dropping. Who knows? That could happen any time. You want to raise the price of oil? Shut down the Straits of Hormuz. You want to get into subsidies? Who subsidizes oil? Well, you got to get oil out of the Middle East. You got to get it through the shipping lanes. Who guarantees the shipping lanes? The old United States Navy. Who pays for that? You do. I never thought I really needed the Army myself, but I spent a little time in the Navy until I got brainwashed. But nonetheless, yeah, I always get a kick out when people start talking about subsidies. The other one is crop insurance subsidy. When you write premium checks, does that feel like a subsidy? I know you've got a lot of you collected this year, but in a lot of years you were writing premium checks. And you were probably wondering, why am I writing this? Because my banker told me I needed it. Yeah, you've been there, okay. Yeah. Anyway, so that's the trade-off. And that's the key. Are we going to have 317 corn? If you don't think it's going to get that low, then this is kind of where you would probably trend to be over in here, would you not? On the other hand, if you're really concerned about prices below $3, and I'm not telling you it can't happen, because it can, and you can't afford to take the loss, because you will be in a loss situation. Well, wait a minute. Anybody got cost of production low enough that they can grow $3 more? Nobody can raise their hand on that one? Okay. I didn't think so. So most of you would be losing money at $3 corn. So if you don't think it's going to get there, same story here on soybean. The break-even number on soybeans is $7.17 to where it's going to flip over. Again, this is assuming your yield, payment yield, is the same as the Olympic average county yield. What if your yield is higher? What if your yield is higher? In that case, the price doesn't have to get all the way to $7.17 before PLC pays for it, if your yield is higher. Reverse, if your yield, your payment yield is lower than the Olympic average county yield, then the payment would have to get, the price would have to get lower than $7.17 before you start collecting more. That's because you're multiplying whatever this difference is, or your payment rate, times this payment yield. And if it's a bigger number, then it makes the payment bigger. Smaller number makes the payment smaller. And so as a result, you have to go further down the price list. Okay? And here's redwood wheat, and then there's a whole bunch of other counties that are in your packet. 484 is the break-even point on winter wheat. Here are the prices. Okay, through 13, right here, all these prices are history. From 14 on, they're forecast. The 14 here are forecast for the K-State. Year 15 through the remaining life of the Farm Bill, those 4 years, these back 4 years, are FAPRI estimates. FAPRI is a division of the University of Missouri. Okay? Anyway, we go down here, and what I did here is I calculated the 5-year Olympic average price based on our estimate in the first year and the FAPRI prices in the back 4 years. So for the first year of corn, I don't expect that price to drop. It is going to go down some if these prices turn out to be correct in the third year. And when we get to the back 2 years, the price drops considerably. Okay? That's based off of these forecasts here, which may not be correct, obviously. Let's assume that the forecast is correct from the University of Missouri. How much do you get paid out of PLC? What's your payment on corn? If they're right. Zero. Because you see all those prices that they're forecasting, they're all below 370. They're all below 370. So they would, if they're right, there would be no PLC payment on corn. Now, I wouldn't bet the farm on a price forecast from the university, even from the University of Missouri. I sure wouldn't bet on K-State's forecast. Yeah. But that's what those numbers show at this point. The numbers in red are the numbers that would actually trigger PLC payments. And you see that, at least based on these estimates, most likely to happen on sorghum. The reason for that is sorghum has a $3.95 reference price. You would expect it to be about the same as corn. It's not, it's substantially higher. Don't ask me why. I don't know how that worked, how that came about. But somebody slipped it into law. And it's $3.95 on sorghum, $3.70 on corn. And as a result, there may be some people that may not want to give up sorghum base as a result, even though they've been planting corn. Anyway, on the wheat, there are a number of years here where they are in fact showing payments under PLC. 550 is the strike. And the break-even prices between PLC and ARC, as I did earlier, this assumes that you raise an average crop and that your payment yield is the same as the Olympic County average. 317, as we already discussed on corn, and the break-even numbers are down here below. 483 on the wheat, and then 488, 493 in the back. Okay. ARC versus individual. It is a 5-year Olympic average farm revenue rather than 5-year Olympic average price times 5-year Olympic average yield. ARC only pays on 65%, county pays on 85%. All farm revenue on that farm serial number count against the guarantee. You can't pick and choose crops. If you go with the county program, Each crop is covered separately. So what happens on soybeans does not affect corn, okay? Here's what I'm talking about. If you have a county benchmark revenue of 529, that's the national average price, and the county elliptic average yield is 90 bushels, that works out to 476, and you have a stop loss of 47.61 times 85%. So effectively, your stop is at $40.47. We do the same thing with the individual, 529. Again, that's the national average price. There's only one price nationally. At the end of the day, we'll only have 5 to deal with when we get to the end. Okay? And we multiply that. Here I'm multiplying it times 150 bushels. So I'm assuming this farm is in a county with a 90 bushel corn number, Olympic average, but on his farm, he's got 150. Okay? So that's substantially higher than the 90. And I multiply that by the 529, and I get $793, 10% stop loss of $79.35, but I multiply it times 65%. That 65% is in the law and will not change. So that brings the number down to $51 and some change versus the county program. So even though in this case, let's assume all the numbers turn out to be exactly correct, a lot of forecasting. At this point, is it worth the extra $9 to go through the paperwork? And that's kind of what you're faced with. Is this enough additional money to make you want to do individual, go to FSA every year, update yield, update your acres, etc., and recalculate your guarantee every year? Because that may not be a huge difference in the payment, is what I'm showing you, because of 65% versus 80%. Okay? What you could do with it, though, if you've got a 100% wheat base, for example, and you don't think there's going to be a wheat payment, but you think there is going to be a corn payment, you could plant corn on that wheat base, go into the individual program, and your guarantee would be based on corn, not wheat, even though what you got is wheat base. So there is a lot more flexibility with the individual coverage. And that might be a case where you would actually use it. So 65% of a corn payment is still more than 85% of no wheat payment. So you got that kind of thing going on. The other thing, as I already mentioned, is what determines your payment in the county program is where you're administered from. Your administrative county, not where the land is located. In the case of ARC individual, that's going to be based on where the land is actually located because it is your yield. Okay? Let's move on to the price, because that's another key factor. And in this case, back in June, the price for wheat was $6.50. That was the cash price determined by USDA, and it's an entire wheat price. It's durum, it's soft wheat, it's hard red winter wheat, it's white wheat, it's white soft wheat, etc. It's all class of wheat put together into one number. So that is the official number right there. The next thing you see, there's 13 there. That's the 13% of the crop was sold in that month. That is a forecast. That has not been published yet. It won't be published for wheat until about the 1st of July. But that number is based off of historical numbers. It is an estimate, but it's been consistent for a lot of years. So that price carries a lot of weight because it represents 13% of the total wheat price. Multiply times 650. You do that with each of the numbers, and then you sum them up. Notice that July has a weight of 19%, an estimate anyway, and 13 in August. If you look at the first 3 months of the marketing year, half the price of wheat is determined in the first 3 months of the marketing year. It's already done. We are clear down to here at this point in January. The red numbers are forecast. The black numbers are numbers that have been published by NASS. Starting at the end of January, we'll get a new report, and these are updated every month. And in January, we will get a new report. And at that point, they will adjust the December number, and they will put a number out, a preliminary number out for January. They will do the same thing in February. We'll get a preliminary number at the end of February, 1st of March. We will get a preliminary number for February and a final number for February. Let me try that one more time. Final number for January, preliminary number for February will be there on March 1. So on March 1, there are only going to be, what, 3 prices left on wheat? And look at the weights. Weights are very small, so those prices are not going to have much impact on this weighted national average price. At this point, I'm at 613. If I'm right, and I'm pretty close to saying I'm within a dime of this number at this point, and I'm not really forecasting how much payment you're going to get under PLC from wheat. Who say? Nada. Zero. What's the word the lady selling you cell phones? No Zambino or something like that, I don't know. But anyway, yeah, who say? Nada. Zero. None. Slim and none. Slim left town. None. Now, what about next year? Well, we can see what we're likely to look at. At 613, that becomes, let's just say that's right, and that's next year's price. And now we do our Olympic averaging. First of all, this drops out next year because it drops out of a 5-year history, because it's a rolling 5-year history. So what's our low price? Well, our low price is now the 570 number. That's currently in the average. But next year, with the 613 price being added in, 570 will be the number that gets dropped out. That's currently in the average. As a result, the price on wheat for next year's guarantee is going up. So you're looking at a higher price next year than this year on wheat. Now, that doesn't mean your ARC County guarantee will be higher, because if your Olympic average county yield drops, your guarantee could actually drop. But if your Olympic average yield goes up, and with a higher price, then your guarantee is even much higher next year than what it is this year. Okay? Remember, you still got that 10% stop loss. What about corn? Well, corn has a different marketing year. Wheat's marketing year is June 1 through May 31st. With corn, you lag further behind. It starts on September 1 and runs through August 31st. And notice at this point, the heavy weights are in these months. You skip December. January's a heavy month. Why do you skip December? You don't want to pay taxes. Sure, absolutely. So, and then you get to the January and all of a sudden, well, you start thinking, well, you're reading about the Brazil crop and, you know, they're going to plant a gazillion acres and, you know, I need cash to make land payments and at the bank, and so we sell some corn. And as a result, that's a pretty, in fact, it's been historically the high month as far as the weighting is concerned. So this month's price is kind of important. The good news is, by March 1st, this is where we're going to be. We will have those two red numbers are going to turn black. These weights are still estimates, obviously. That, again, will be over half the corn price will be available to you by March 1. And you'll start to make some decisions whether or not how likely you are to collect payments. At this point, I'm at $3.99. A month ago, I was at $3.84, so it's come up some. At $3.99, if that were correct, I don't want to say much here at this point. I'll say a lot more on March 1st. But if I'm correct, then there would be no PLC payment in the first year on corn. And if factory's correct about the back four, then that may not work out so well. But again, a lot of things can happen. There's nothing the decision can't have 280 corn. Costs more than that to produce it. Market doesn't care. They can buy it for 280, that's what they're going to buy it for. Okay? And if you're feeding cattle or you're feeding dairy cows, do you really care if that farmer is not making money? Not really. If I can buy it for a penny less, that's what I'm going to do. But that adds to my bottom line if I'm feeding hogs or milking cows. Right? So it depends on which side of the desk you sit. I get reminded of this by my brother. My brother has no farming interest at all. They're cow-calf producers. So what he's got is hay and cows. That's it. And so he was complaining back about me a few years ago about those high corn prices. I heard all about that feed cost. Now he has to admit that he's making a little money. Boy, it's hard to squeeze that out of him too. Get him to admit that he's actually making a little money. I know he's making money. Yeah, with the lower corn prices, all of a sudden cash prices have come up. People want to feed cattle again. Yeah. It like it's always been, moves around. Okay, We will be able to save more on March 1, but looking at where we are today, if it were $3.99, that's close enough. Let's just call it $4. If it did come into $4, first of all, the 370 number is going to drop out of this distribution. And what would be our low price next year? Well, it would be the $4. And so the Olympic average price will be the same next year as it was this year. So the price of corn, I really don't think is going to be lower next year. It'll be the same as it is this year, $5.29. That'll be the first 2 years of farming. Now, that doesn't mean your guarantee is going to be higher because you have to look on the yield side. Is the yield higher or lower? Okay? Now, moving on, this is soybeans. On the soybeans, I'm at 973, and I've gone the other way on the soybeans. I'm down a little bit on those. But in any case, at 973, first of all, we can see this number is going to drop out, and we plug in the 973 there. Well, next year, that's going to be the low number. That drops out, and we're going to be averaging the same three numbers that you've been averaging. The high price here, of course, is the 1440 number. Okay? 1440. Anyway, and bad news is that's going to drop out further too. And for that reason, in the second year, I'm not suggesting it's going to go up. Stay the same, 1227. So for the first 2 years. Okay, moving to the yield side, and there's redwood, but let's look at blue earth. The reason I want to call your attention to blue earth is right there. These are the historical county yields for that particular county, and look at the variation in the yield. There isn't much variation, is there? If you had a county yield, for argument's sake, that came up with a mean, and the standard error of that mean was 0. In other words, there was 0 variation. What does the ARC County program default to? If you have no yield variability, think of the extreme. That isn't going to happen, but just think of an extreme case where there's no yield variability. It's 0. It's not 4%, but it's actually 0. What's the default to? That is a put option. Is it not? Yield doesn't change, and the only thing that's going to drive claims is prices. What kind of a strike price do you have in that put? Take 86% times 529. And I believe that's, anybody have calculated 86% of 529? That will give you the exact number. I think it's 486, something like that. That gives your strike price. How valuable is a put at that level? We're what, roughly 420, somewhere in that neighborhood on the board right now for new crop corn. And probably this matches up better with March than December corn because of the delay and the waiting and all that sort of stuff. But at that level, that's a pretty valuable put because it's in the money. If you didn't think this was going to pay, you could simply go sell that put today. And if you're wrong, then you would start to collect payments from this program to offset your margin calls on that put that you sold. Now, if you haven't lost money trading options, I don't suggest you go do this. Okay? Only people that should consider selling off their coverage through the option market are people who have lost money trading options. Because you will get a real education if you do this. You've never done it before. You don't want to do that. Even if you've been through a half dozen seminars, I wouldn't suggest you do that. Nonetheless, blue earth has very little yield variability. And which means as long as that yield doesn't vary, because what people forget is, well, doesn't that mean I get bigger payments if I got a lot of yield variability because the yield was low and it triggers payments? The problem with that is, let's say you have a yield that's 50% below the average. We get those kind of numbers in the Great Plains. It doesn't do any good. Why not? Because you hit the 10% stop loss. So it could only be down 10% yield lower, and you'd get the maximum payment, or 15% below normal, and you get the maximum payment. The fact that it's 40 doesn't do a thing for you because you're stopped out at 10%. On the other hand, if you have a yield variability of plus or minus 40%, that means it can be 40% higher than the average. It goes the other way. What happens when it's higher? It cuts into the ARC payment. Higher yields cut the payment. And there's no stop loss to the upside. There's only a stop loss to the downside. So as I look at this program, I think the counties that have low variability will benefit the most because they've got puts that are based off this historical price that were in the $5 and $6 range, now coming home in the average. So you're getting a put that's in the money. And if there's no yield variability, then it's strictly a price instrument. You know, 480, somewhere in there, you calculate the number. That's a lot higher than 370, is it not? That should tell you something about what's most likely to pay in it. But you got a lot of yield variability. What worries me there is that yield variability runs both ways. And if you get a really high yield, and I'm talking in percentage terms, whether you're dialing 200 bushels as an average or 100 bushels as an average, but if you, on a 100 bushel average, and you raise 150 bushels, which can happen if they get a little rain, then all of a sudden you're out of the payment. Now, the folks that really love art will say, well, art, that's not relevant because they don't need the money, they got higher yield to offset it. I'm sure that's true, but you all want government money, right? I don't care about risk management, I want the government. So, it's going to vary a lot from where you're at. Now, Redwood doesn't have a lot of yield variability either, if you look at the recent history anyway. Probably one of the things you'd like to do is take this photo back. One of the things I did was I assumed that that the yield that came in 14, and we don't know that number, we won't know it until April. If that county yield comes in at the average, which I suspect it probably wouldn't here, but if it did, then next year's Olympic average is 165. It would actually go down from 170 to 165. If that yield comes in with a yield that's low, and in this data set, what I'm defining as the low yield is the 150. So if it comes in at 150, next year's Olympic average yield is 158, which drops it from 170 down to 158. If I come in with a yield equal to the high year, which is 187, then next year it wouldn't change, it'd be at 170. So I need a 187 yield in this county for it not to go down next year. Everybody see that? For it not to be lower next year. Price is not going down, but I would guess your guarantee is because I suspect you did not get a 187 bushel number. Now with the individual, you already know that 2014 number, don't you? Because you already know your yield. So if you're calculating, you can calculate your yield, your payment today, pretty close to it, if you go to the individual route. If you're going county, the problem there is we don't have the county yield and won't get it until about the middle of April. Okay? Now, when I look at where this thing is at, I would not be shocked if they don't extend the sign-up date, but don't plan on it. I still plan to get done by early March. Don't want to put this off at the last minute. I also expect that you'd be allowed to change your mind if they do give you additional time to sign up. Would that help if you had additional time? Yes, it would. Why? Because all of a sudden now I've got 14 county yield in the distribution, and I'll be able to pretty much tell everyone in the country what their expected payment is in that county. Their payment per acre anyway, per payment acre in the entire country. You'll be able to fill it in. And then, so that takes care of the 2014 crop. Right now, I'm estimating 15 crop to see I can move those numbers out another year. I'll be estimating the yield for 16 at that point. So that's the first 3 years of the farm bill. That's a lot of new information that we would have by the middle of April. So, if any of you know a congressman, you might whisper in their ear, it would be really nice if you extend the sign-up because, you know, this is too much paperwork. We can't get it all through the system. Nobody can get all this done. You don't want to tell them because you want to put the government cow up there so we can milk her. She deserves to be milked, but nonetheless, you probably don't want to make that argument. You want to argue, we need the extra. I've also seen a Corn Belt economist arguing, read one of his papers, he's arguing they should extend the time. His logic was because wheat has more information than does corn. That's absolutely true, we do, because the marketing year is further along. But the really big number is that county number coming in October. I've also heard rumors that maybe they will put out an estimate of the county yield early. And even that would be helpful. Okay? So there's still a number of things that are out there that are not going. I've done the same with the soybeans, with those numbers on yield, same thing with those numbers. Now, what I'm showing you here is Thomas County, Kansas, And what I'm looking at is comparing the ARC county versus the ARC individual. First of all, I said, suppose the farmer had the same yields as the county. So this is the average farmer that doesn't exist. But let's say he did. Well, the way this works is the Olympic average yield, which is 182 in this case, and the Olympic average price, which is 529, multiply the two numbers together, and the benchmark revenue is $965. Under the ARC individual, got the same yields, same prices, but we multiply them together because it's the Olympic average revenue. So multiply these two numbers together, there's the revenue for that year, the revenue for that year, the revenue for this year, etc. And we come up with $96.58. So the benchmark is pretty close to the same number as what I got doing it with the Olympic average times the Olympic average yield. But it does vary a lot, and a lot of it's going to depend on what the distribution is. If you look here, what yields that we throw out, the high yield is right there, and the low yield is right there. That gets tossed. Down on the revenue, though, the yield that gets tossed is this year. Oops. This year gets tossed, and the low revenue is 640 gets tossed. Right? Yeah. So you see there's different years that are getting dropped out of the distribution. And when you go forward to the next year, this one's going to drop out this low revenue. And because you already know your 14-year yield, you can come up with a pretty good estimate for your 14 revenue that's going to come in. So all of a sudden, you can look not only what's going to happen this year, but the next year in the farm. Make sense? Got a lot more information for the individual. Although that would even out if they do delay it and we have those county yields, or if they publish the county yields early. That should happen. So what to choose? Well, as a general statement, at this point, certainly doesn't look like wheat's going to pay in the first year. I can almost guarantee that. The next year, we know the price is going to go up. So it kind of depends on what happens to the yields in your county. By the way, in order to get our county payment on the wheat, it's going to require a yield loss in that county. If you don't have a yield loss, there's still no payment. The prices are that high. Okay? On the case of sorghum, it's the one most likely to collect payments under PLC of the crops. Doesn't mean that they won't get paid under R too, it's just most likely to have PLC payments in sorghum. And you saw the other numbers. Basically, in order for that payment to get bigger under PLC, you need corn prices down in the 320 range, and you need soybeans down in the $7.20 range before the ARC county is going to pay less than PLC. So that leads us to, you really need to run these numbers for your farm, because it's going to depend on what the yield distributions are, as I showed you. And all those factors come into play. So what you need to do, in my estimation, if you really want to understand the ins and outs of this, is to run it through one of these computer models and run a bunch of different scenarios, high prices, low prices, etc., to really sort out which one of these is likely to work for you, or at least you hope works the best for you. Now, what I'm going to show you just real quickly is our decision aid. With a little bit of background information here, I learned yesterday's meeting that Minnesota Extension Service is using the Illinois decision aid. Illinois decision aid is online at FarmDoc. You can Google FarmDoc to find it. I think it's an easy one to use, or at least that's what I've been told, very user-friendly. It is online, so you do have to have internet connection. And if your internet's a little slow, that may set you back on some of those programs. You are entering your data, it is going online, it's going on to a server there. In our case, ours is totally on your machine. It's an Excel-based program, which means you download the program. You don't send your data anywhere. It stays strictly on your machine. All the calculations are done on your machine, so if you got a slow internet speed, you don't have to sit there and watch it download. But once it's loaded on your machine, then it's going to run as fast as what your machine does. However, ours has a couple of limitations. Number one, you have to have Excel. It doesn't run on anything else. And it has to be a reasonably new copy of Excel. If it's more than 10 years old, it might not run. The reason is this uses all the drop-down menu stuff, and it's got the data loaded for every county in the country. So it's sorting through those data files. And the older versions of Excel don't support that. So the other thing is we don't cover cotton. I'm not sure Illinois does either. Texas A&M covers cotton. Cotton is a totally different program. And you notice we didn't talk about cotton today. And in Kansas, we are going to have one meeting where we will cover cotton. We'll be in Wichita next Monday. So for some reason, if somebody in the room wants to know something about cotton, you can fly down to Wichita and again, call us if you're coming. We want to make sure we got a room for you after you come down. But nonetheless, we're bringing someone up from Oklahoma to talk about cotton. We simply have not really dug into the cotton program. The other thing is, initially, we didn't think we were going to get any money to actually do the education at land-grant universities. The story was we were broke, and they were going to sequester funds, and the whole 9 yards. And so, and we started thinking about this 2 years ago. We could see how big a problem this is going to be trying to get everybody educated on this program, particularly the economics of it. So what we're going to do is charge a registration fee. That's how we were going to fund things. And as a result of doing that, we had a number of corporate sponsors come to us and say, hey, we'd like to pay that registration fee for our customers. Well, it didn't matter to us. So we went along with that idea, and so if you came to one of our workshops in Kansas, you're going to have corporate sponsors all over the slide set. Hopefully that don't bother you, but that's who's paying the freight. Well, make a long story short, the government decided they were going to have to provide us some funding. That they couldn't expect the universities to do this without some additional funding. So they did what they call as formula funding, and that went down to all the universities based basically on the number of farmers in the state. For example, Iowa would have got more than Kansas. Kansas would have gotten more than what Oklahoma did for this purpose. Anyway, and since neither one of us had a lot of resources, we decided to work with Oklahoma State. Oklahoma State received a grant to build this thing, actually 2 years ago, and then they said, we won't fund you until they pass the Farm Bill. Well, when they passed the Farm Bill, they called this young lady up and said, well, pass the Farm Bill, we're willing to fund your grant now. So, okay, you're not going to send money back. So she started down this road, and she talked to us about joining in with them on doing the work on this particular project. Now, that's where it gets interesting, because you'll see the color combination. You see it's mostly orange and a little bit of purple. Now, how that came about is I went to my department head and I said, you know, I'd really like to have K-State's name on it. We're going to get involved with this. And they want some cash to do that with. Well, sending cash from another university to another university is almost impossible. And particularly to a university that you compete with for graduate students, and also people who have 4.2 speed. Anybody in this room got a grandson, son with 4.2 speed? Do not leave. I want to talk to you. We got a deal for you. You need to come to Kansas State. Best education in the country. 4.2 speed. That's what we need. Hope he pays you that. Anyway, on the other hand, so we ended up sending them a check. As soon as Oklahoma State got the check, they called me back and said, hey, you'd like to have more purple on there, send us some more cash. I went to my boss and I said, do you want to send more cash? He said, no, I don't think so. I think it's got enough purple on it already. So that's how the color combination came out. One last little caveat on how crazy this was. 2 years ago, A&M thought they were going to get $3 million to build the decision maker. Well, at the last minute, they decided to split the $3 million between A&M and Illinois. And that's why Illinois has a program on their website to do this kind of work. And in that case, when they split it, Illinois got $1.5 million and A&M got $1.5 million. And then in the funds they sent down to us, they had two caveats. Number one, you couldn't charge, and number two, you had to use either the Illinois or the A&M software. So technically we can't use our own. But what we're doing is we're using the A&M software because we don't have cotton in our program. So you have to use the A&M software to cover cotton. So that's our story, and we're sticking to it. Illinois program will do probably what 90% of you want to do. What is different about ours is simply if you like the spreadsheet sort of approach to things, you control all the numbers, you can see how they're all calculated since you've all been through the math, and you can actually go back and see why the results came out the way they did. There's nothing that's hidden in the program. There's not much black box stuff going on. But if you just want an analysis, probably Illinois is the easiest one to run. Although I've been told, again, depending on how experienced you are with spreadsheets, some people actually prefer this. But in any case, I think you ought to use some of this. As I said, it has all these drop-down menus, all the crops except for cotton, all the counties in the states are here, and then you pick out the counties that will pop up. These are all pop-up menus. In this case, we picked Oklahoma, we picked Garfield County. What that does, and then we go in and fill in our data, our APH, in this case, our base acres, our FSA program yield, and in this case, the reallocated base, and that's coming from what you entered for your farm historical yields of planted acres. Based on what you planted during these years, 9 through 12, it goes through and reallocates your base. Well, see, in this case, he didn't plant anything but wheat, so there's no reallocation of base that can happen here. Okay? But if he'd been planting something other than what his current base is, he would get different acres. Now, he did plant different crops in 2013, but that number doesn't come into play. Why not? Because it's only the history 9 through 12 for reallocating base acres. So the fact that he planted a different crop in 13 does not matter. Okay? Anyway, it's going to go through and recalculate these numbers for you. The updated base as well as price. And in this case, the current FSA program yield is 44 bushels. The Olympic average yield from his history works out to 36.5 bushels. So in this case, he's not going to want to update that program yield, is he? He wants to keep the 44. And over here, it assumes, when it says updated yield, it assumes that you kept the higher of the two yields. It assumes you take whichever's higher. Anyway, it goes through and it fills in prices. You have to fill in what acres you intend to plant in the future. This guy has wheat base, but he's planning to put corn in there some years. Going to put some canola in there, but he's planting wheat every year. So he's not planting whole wheat today, all the base of wheat, even though all the base is wheat. Here are the prices. These prices are being filled in by factory. This slide's out of date at this point. Factories come out with some new prices. Those have all been loaded into the software. So unless you had an old version of this, which you wouldn't want to keep, these will be coming differently. If you don't agree with any of the numbers, you simply click on that cell and you type over with what price you think it should be. Doing the same thing as far as entering the data for your county. Again, it's going to fill those in where it has numbers, fills in the yields, prices. Again, you can override those if you don't like what it fills in. And it comes up with a result here, and we are showing some payments for the Barton County in this case. Now, if you change the assumption, obviously we're going to change the results. And it's comparing it under the old allocation and the reallocated base. In this case, they're the same because you really can't reallocate base because you didn't have anything but wheat. Okay? Anyway, similar approach for the our price loss coverage program, the PLC. Again, these are filled in with factory prices. If you don't like any of them, you just override them. In this case, we did come up with a small PLC payment on wheat in year 15. And if you go back and look at their prices, that probably tells you why. We expect to see something there. Again, the price has to be below $5.50. And it then gives you a summary of all of the crops together and a summary for the whole farm. Again, if you come through our site, what you will get is it will ask you for an email address. What it does with the email address is if there's an update or a major change in the program, FSA makes a change, or we find a programming error and we update the software, you will get an email from us telling you what was changed and telling you that you should go now and re-download the software. In the case of Oklahoma, they're not able to track emails. They don't know who came. And in that case, what you have to do is go back and check every once in a while. Now, if you don't want to leave us an email address, that's fine too. You don't have to. You just won't get the note that it's been updated. Okay? And we're not going to do anything with those emails. They're all going to be destroyed. When we're done, we're done. They're going to go. Period. So they will be gone. Finally, we got a number of things that are on that Ag Manager site. And I really should have put this in your handout, and I didn't. This is a slide I didn't get in the handout. It should have been there. But on Ag Manager, we've got, first of all, videos of all three of those worksheets. So if you need to go back and review any of those, you can. This Farm Bill decision-making step basically walks through you the Excel program for making decisions. If you got a landlord that really doesn't get any of this stuff and wants something simpler to kind of get up to speed on, I would suggest that you print these two documents right there and send it to them. One is frequently asked questions on this commodity title program, and the other one is a glossary of terms. So, you know, you got a lot of acronyms that are being used by FSA and other folks. It tells you what those are. So if you're at the beginning stage, those are the two documents I would suggest you look at. Okay? And these are people, and they are here, that you can contact. If you have a problem with the software, I would send it to her first. She will respond. She's been doing nearly all of the revenue, all of the reviewing that's going on. And the coding is being in Oklahoma State, if that is of interest to you. Okay, so we went through a lot of stuff here. Hopefully, with what's here and what's on the website, this can get you everything you ever wanted to know about this farm program. I know a lot of you have been through other meetings with FSA and other folks. Just out of curiosity, is this the first time anybody's gone through how you actually calculate the payments? Was that new? Okay. So hopefully that gives you some more insight of what's in the background of the software. If you're running your numbers through Illinois, for example, you get something that doesn't look right, you got a way to fact check. Don't assume just because it came out of the computer it's right. Okay? Let's see, where are we at this point?
Questions?
Yeah, any questions?
Oh
Yes, go ahead.
Something about the only time we go and do the acreage report anymore is with the individual part.
I imagine they're still, I would guess they still want you to report your acres.
Still, yeah.
And in fact, I'll tell you why. Because in the county yield number, what that's actually going to be is the county yield will be harvested yields plus failed acres. And the failed acre number is mostly going to come from RMA, but a cross check will be what you report to the FSA office too. So I would guess they're still going to want that number. And you definitely want that failed acre number in there because you're going to make the county yield lower than otherwise would be the case if you're in a loss situation. Because that's when you get a lot of acres that don't get raised, right? Okay. Yeah, the landowner
Art,
has.
can you repeat the
question?
question?
Is, who has to sign off on these documents, basically, okay? In the case of reallocating base and updating the program yield, the landowner has to sign off on that. Now, the reality is, that's what I heard last night, what I've been told in Kansas, if you have power of attorney, you can sign those documents for them, but I didn't hear that last night, whether or not they're doing that here or not. But, so it is the landlord's decision on updating payment yields and reallocating banks. Either he has to sign, or if they will accept power of attorney, he still ultimately has control. When signing up for the program, if it's cash rent, both have to sign, tenant and land. Excuse me, if it's crop share rent, both have to sign. If it's cash rent, then the farmer makes the decision, the tenant, on which program to allow. Now, if these hybrids that are flexible cash rent, those kind of things, sometimes they're based on a minimum number of bushels will be guaranteed. Those kind of contracts are being viewed, at least in Kansas, as cash rent. So again, the decision is the farmer. Okay? The only exception to that I'm aware of is where it is a true crop share. Then both have to sign. Did I get the question? Yes. Question over there?
Well, no, I was at an FSA meeting yesterday, and they were saying that the change base and whatnot, the operator, the current operator can do it. The current operator can change the yields and the bases.
The current operator can change the yield in the base acres.
Yes,
I would agree if he has power of attorney.
yes, that was also included.
Yeah, if he has power of attorney, I would agree with that statement. Yeah, okay. Any other quickie?
Art, talk a little bit, you talked about the 10% stop on the eligible payment. Talk a little bit about the 125,000 limit and the 900,000 eligibility.
Well, there's two limits in this. One, you have to have an adjusted gross income under $900,000. Now, that's over a period of 3 years. So, but that is not your gross farm income. And what they're thinking of terms of is an individual Schedule F. Now, if you've got a corporate farm and some other things going on, probably makes this a lot more complicated. But with a single taxpayer filing a Schedule F with a 1040,